Reverse mortgage after death. Probate options: sell, keep, or walk away. If you're serving as an executor or an heir and the estate includes a home with a reverse mortgage, you're probably wondering what happens now. The good news is that you have options, and no one will come after you personally for the loan balance. In this video, I'll walk you through the 5 options available to the estate, how the timeline works, and what steps you need to take right away. I'm Terry Peterson with St. Louis Family Resources. I talk with people every day just like you that are managing an estate, probate, or exploring senior transitions. I open my Rolodex of service providers, contractors, and professionals I've amassed over the past 20 years to help our clients meet their obligations in managing the estate. I invite you to reach out to me via text, phone, or email. Now back to the video. What is a reverse mortgage? Most reverse mortgages on homes today are HECMs, home equity conversion mortgages, insured by the Federal Housing Administration, FHA, under the U.S. Department of Housing and Urban Development, or HUD. This is an important detail because FHA insurance is what protects the estate from ever owing more than the home is worth. These are non-recourse loans. The 5 options for the estate. Once the last surviving borrower passes away, the estate generally has 5 ways to handle the reverse mortgage. Number 1, keep the property. If an heir wants to retain the property, they must pay off the reverse mortgage loan in full, but never more than 95% of the home's current appraised value. Because of the FHA's non-recourse guarantee, no one can be required to pay more than the home is worth. Number 2, sell the property. If the home's value is greater than the loan balance, the estate can sell the property. The loan is paid off at closing, and any remaining proceeds go into the estate for the distribution once the probate is closed. This is the most common outcome. Number 3, complete a short sale. If the loan balance exceeds the home's value, a short sale may be possible. To satisfy the lender, the property must sell for at least 95% of its current appraised value. FHA insurance covers the lender's shortfall. The estate owes nothing more. Walk away. Allow foreclosure. If the home is underwater and the estate has no interest in selling or keeping it, heirs can simply walk away. The lender will initiate foreclosure proceedings. Because this is a non-recourse loan, there's no deficiency judgment against the estate or heirs. Your personal assets are protected. Deed in lieu of foreclosure, number 5. Rather than waiting for a full foreclosure process, the estate can voluntarily transfer title of the property directly to the lender. This satisfies the loan, avoids the foreclosure timeline, and like all 5 options, results in no deficiency judgment against the estate. The critical timeline. Time matters. Here's what happens after the last surviving borrower passes away. Within 30 days of the borrower's death, the loan servicer sends a due and payable notice to the estate. This notice includes information about the loan balance, repayment options, and eligibility requirements for a deferral. Within 30 days of receiving the due and payable notice, the estate must respond with a written letter of intent stating how it plans to handle the property. The lender must also order an appraisal of the property within that same 30-day window. Within 6 months of the borrower's death, the estate has up to 6 months to sell the property, pay off the loan, or otherwise satisfy it. Note that the interest continues to accrue on the loan balance during that period. After 6 months, if the loan remains unpaid, the servicer may begin foreclosure proceedings. Extensions available. In some cases, the estate can apply for up to 2 90-day extensions, which could extend the total timeline to 12 months from the date of death. However, extensions are not guaranteed, and most estates have only the initial 6 months to work with. What about a surviving non-borrowing spouse? If the deceased borrower had a spouse who was not listed on the reverse mortgage, that spouse may be eligible to apply for a deferral under HUD's Mortgagee Optional Election Assignment Program. This can allow them to remain in the home without having to immediately repay the loan, provided they meet HUD's eligibility requirements. If a deferral is not granted, it's especially important to consult with your probate attorney right away to understand the obligations and timelines involved. In summary, no matter which option the estate pursues, there's never a deficiency judgment against the estate or heirs. FHA insurance makes the lender whole on any scenario where the loan balance exceeds the property's value. You are protected. That said, the timeline is tight. The moment a borrower passes away, the clock starts. And acting quickly and deliberately is the best way to protect the estate's interests. Questions? I'm here to help. If you're navigating an estate with a reverse mortgage, I'd be glad to walk you through your options. Visit us at stlouisfamilyresources.com for additional resources or reach out directly. I'm Terry Peterson with St. Louis Family Resources. I'll see you in the next video.